Okay, welcome back everyone. So in this session, we are going to focus now on question 6.4. So what we're going to do is we're going to go through it. Now, because I did question 1 with you guys, I expect that you guys help me with those questions and tell me what you think we need to do. Okay, so let's start off with what is required of us, and then we'll read through all the additional information. So in this information, or in this question, they ask you to calculate the tax liability for our year of assessment, 31st of March 2021. Okay, so if we do tax liability, what does that mean? What do you need to calculate? Okay, so I'm going to repeat that. If we have to work out the tax liability, what are they telling us? What are we basically calculating? That's correct. So it's the taxable income multiplied with the applicable tax rate. Now, when we get to the top of the information, you guys will see it is a SBC, so that would mean we are applying the SBC tax rate for this question, which is a sliding scale. Okay, so our year of assessment is 31st of March 2021, which means our tax period is 1 April 2020 to 31st of March 2021. Okay, so that is when our tax period is for, just to help you put the 12 months into perspective. Okay, so let's go through the information. They tell you Menora CC is a small business corporation. Now, as soon as you see small business corporation, you need to think about section 12E, which is your capital allowance for your assets. Okay, now if it's a manufacturing process asset, what will the deduction be? So if it's an asset we use in the process of manufacture, what is the deduction we will receive? Okay, so now 12C is for a normal company. So section 12E, similar to 12C, but this one relates specifically to a small business corporation. So when I ask you what the deduction will be, I am asking what percentage will a company be able to claim. Okay, so let me rephrase that. If the small business has an asset they use in the manufacturing process, what percentage will they be allowed to deduct in that year?
Ma'am, isn't it the 50%?
Okay, so it's 50,
Year
30,
one.
20.
Yes.
Yes. So that's for non-manufacturing assets. If it's a manufacturing asset in terms of section 12E, it's 100%. Okay, so just remember when we look at small business corporations, if it's anything to do with manufacturing, the full amount can be deducted 100%, whereas if it's any other type of asset, it's 50, 30, 20%. Okay, so now let's go through this information. They tell you we manufacture blades and other cutting products. Our year assessment is 31st of March, and we provide you with the following information. So I'm going to do a few points and then we go fill it in on Excel so that you guys can do it with me. Okay, so the first information they tell us is that the sales is 12,250,000. Okay, the purchase of raw materials was 9,188,000. Okay, just before we move on, something that I saw that came out of the test that you guys wrote. If they do not specifically indicate anything regarding VAT, so they do not talk about VAT, they do not state that it's inclusive of VAT, they do not tell you the person is registered for VAT. You do not bring VAT into account when you do the question. You take the amounts as is. Okay, so only when they tell you specifically amounts are inclusive or exclusive of VAT, we are registered for VAT, do you bother to do anything with the VAT? Because a lot of students, for example, took this 12 million and then removed VAT, whereas the answer is actually the 12 million. Okay, I'm quickly going to share the Excel file and then we start populating the information based on what we've got here. Okay, so let's quickly share the Excel so that we fill it in as we continue. Okay, you should see the Excel file on your screens now. If you don't see it, please let me know. Okay, so the first thing we have to show is we said sales was 12,250,000. So we show the 12,250,000 in our taxable income. Okay. Then the second thing we had was the purchases, which was the 9,188,000, and we deduct that from our taxable income. Okay, so that was the first two items that you would populate and you would receive 2 marks. Okay, let's share the PDF again. Okay, so if we then move on to point 3, we see we purchased a delivery vehicle for 251,500 and we brought it into use at the same date. The delivery vehicle is still in use at 31st of March. So we haven't disposed of the delivery vehicle. So in terms of section 12E, we said that if it's a non-manufacturing item, so it is anything else, we would apply the 50, 30, 20% rule when working out the capital allowance. Okay, so our capital allowance for this, because it is bought in the current year, we would apply the 50% rule and there is no need to apportion it based on this section number. Okay, so I'm just going to put it in here so that when you go through it again, you can remember that. Then on the 2nd of February, we purchased a new manufacturing machine. So they tell you it's a manufacturing machine. It costs us 855,000 and it's used directly in the process of manufacture. Okay, and it was brought into use on 5 February. Okay, so what did we say is the rule? If we've got a manufacturing machine in terms of section 12E, how much can we deduct for this year? What percentage can we deduct? Okay, so for manufacturing, if we use it for manufacturing specifically, and we apply section 12E, what percentage of that asset's value can we deduct in our current tax year?
Ma'am, is it not 100%?
Yes, that's absolutely correct. Thank you. Okay, so we can deduct 100%, and similar to the previous comment, I'm just going to copy this as well. We do not need to apportion it at all. So you get the full amount you deducted in that year. Okay, let's move on to point number 5, and then we'll go populate point 3 to 5 on our Excel. We sold a computer on 15 January for 8,000 to a second-hand trading company, and we originally purchased it on 25th of August 2018 for 14,500. Okay, so now what we have to do is we have to go work out, okay, if we look at the years, how many years did we have? So year one would have been in 2019, so it would have been from the 25th of August up to the 31st of March 2019, we would have had 50%. Then in year two, which would be 2020 year, we would have applied 30%. And then in year three, we would have applied the 20%, and that would have been in the 2021 year. Now, because of the fact that we sold it in the 2021 year, that means we would have applied the 20% for the capital allowance, and we sold it for 8,000, which means we also have a recoupment amount in that year. So we have actually recovered of what we've deducted. We have recovered 8,000 Rand. So we initially had 14,500. We've written it off, so the tax value is 0. So that means it's the 8,000 would be what we compare to our tax value, so we would have recovered 8,000. Okay, so let's quickly stop sharing here. I'm going to share the Excel file again with you guys. Okay, so the first thing we said when we go back to point 3 on our workbooks is we said we purchased the delivery vehicle. Now we will apply the 50, 30, 20% rule because it's a non-manufacturing item. We said we are in year 1, so we purchased it in that year. So we take the value, the 251,500, we multiply it with 50% to work out our deduction. Then in point 4, we said we purchased a new manufacturing machine. We said because of the fact that it's relating to manufacturing, we are allowed to get a full deduction of 100%. So we take that 855,000, we multiply it with 100% to get 855 deduction. Then point 5, we purchased a computer, but already in 2018, which means if we look at our depreciation years, 2019 would have been the original 50%, 2020 would have been 30%, so that means in 2021 we still have 20% that we can deduct. And then on top of that, we have to work out what is the recoupment value, which is the proceeds less the tax value at that stage to work out what have we physically recovered. Now let's quickly have a look at how to do that calculation. So the first thing is we show our cost. Let me just write here the cost was 14,500 initially. So in year 1, our deduction would have been 7,250. In year 2, it would have been 4,350. And in the current year, we still have a 2,900 which we deduct. So when you do the allowance, you only include the current year's deduction. You do not show the prior year's deductions. So that means our tax base is currently sitting at 0. Just going to move that there. Let's just leave it where it is. Okay, so now we want to work out what is the recoupment amount. So you first start off with the recoupment. We have the 8,000, which is the proceeds, is limited to the 14,500, which is the original cost, less the tax base. Now, because of the fact that our tax base is 0, we cannot deduct anything. We do not have a value to deduct. Because the 8,000 is limited to the 14,500, you take the lesser of the two. So we're going to apply the 8,000 when we work out our recoupment now. So we say we've got 8,000. We've got 8,000. We deduct the 0 to give us 8,000 recoupment. That's basically how the recoupment works. But then we also have to work out, is there any capital gains tax? Now, because the proceeds is 8,000, we've recovered 8,000 through the recoupment. Our proceeds would be 0. Our base cost was the 14,500, which would also have been part of the recoupment, which means there is no capital gains tax for this item. Okay, so that's how you would have to show the capital gains if you had to indicate capital gains in this question. Because it's still not, we haven't discussed it as yet, we're just showing you how you would have done the calculations. Okay, so that was up to 0.5. So let's then go back to our PDF and then continue with 0.6. Okay, so if we then go to 0.6, we talk about during the 2015 year assessment, they erected a new factory building with a total cost of 12.750 million, and it was brought into use 1 July 2016. Okay, so that means new factory building, we need to apply the 5%. But remember, when we've erected something, we apply the 55% to that amount. Okay, and 0.7, let's quickly see. Due to the lack of office space, decided to purchase a part of a new commercial building. So we've got a new commercial building, we've purchased it, and it's used for office space, and that was 2.23725 million, and it was brought into use in the current year. Okay, so we also have 5% for that. Okay, so for the factory building, we apply, it is at 5% over, I think it's 20 years, whereas this is at 5%, but only for a value of 55%, because it's for office space, it is not in the it's not the factory where they manufacture it. Okay, so that's 0.6 and 0.7. Okay, let's do the Excel again. Okay, so that means for our factory building, we apply the 5% to the 12.75 million to deduct it. And then for the office building, we apply 5%, but we apply the 55% as well because we've purchased it to get to a value of 61,000. Then you add all of that together to get to your taxable income for the year. And then the last step is, because we have to do the tax liability, we then apply the tax tables. Now, because I haven't given you the tax tables, you would apply the 1.3, sorry, this is 1.387505 less 550 and multiply that with 28%, and then you add the 58,583, which relates to the 550,000 amount tax up to that point, to give you a tax amount of 293,084. Okay, so the sliding scale for this will be provided in a text test or an exam. It's generally part of the annexures. Okay, do you guys have any questions on question 6.4?